Welcome to our annual presentation on Climate Week NYC. And today's topic is about carbon markets transparency as a critical factor for reaching net zero. And we're going to go through a few interactions here of why this is the case. But I wanted to start the story from the beginning. Right? We're going to go through a very, very brief overview on how this whole thing starts, especially for the benefit of those who are not as much embedded in the carbon markets today, so that we can create some context for the discussion about market transparency. So we're going to start with a very brief overview of the climate challenge. So carbon markets related to climate change, for climate change mitigation, right? And we need to understand first, in terms of numbers and in terms of future projections, what actually is the climate challenge that we have ahead of us. So after that, I'm going to go through a very brief summary and overview of how the voluntary carbon market works. So we usually call this VCM, and we'll explain also why it's voluntary, right? Why the name voluntary ahead of the carbon market denomination. So once we understand that, clearly we jump straight into the market transparency journey. What exactly is market transparency, and why is this so important, right, for the carbon market, and in turn to be a contributor towards the achieving the goals under the climate change targets. So I'm going to close with an onward and upward sort of overview, basically where we are and what we see ahead from this point on. And finally, we can close the presentation with Q&A. Okay, but first, let's take an overview of the climate challenge. The whole thing really started in the 90s, right? Officially, right? With the Earth Summit in Rio 92. That's officially probably the first time people brought climate change and climate change issues and prospects for targets to the agenda. So it was really a turning point, right? There were discussions in the 80s and so on and so forth, but didn't really go anywhere. But in 1992, things became really more serious and more targeted. So fast forward 5 years, and there were a lot of discussions. There are always a lot of discussions in between these big milestones. We had the signing of the Kyoto Protocol, and a lot of you probably are aware of the Kyoto Protocol. It was the very first mechanism for tackling climate change. And what the Kyoto Protocol really instituted globally was a global market for climate, which involved both governments trading with each other, and the trading was based on allowances. Certain countries who had commitments had allowances, and they traded those allowances for those who had surplus. Those who had shortage had to buy from countries with surplus, and so on and so forth. That's really how a market works. But in the background, there were those developing countries without targets that could still supply assets or I would say units into that trading scheme through offsets. So there was a mechanism called Clean Development Mechanism, which was supposed to be developed only in developing countries to develop carbon projects that generated carbon credits that in turn could be used into the compliance schemes of the countries with targets. Now, the Kyoto Protocol only really came into effect in 2005. So once an agreement is signed, there is a long road and a long process of discussion, of interactions among countries, and obviously the private sector is part of that process to actually get that implemented. And the implementation really came from 2005 onward. Just to cut long stories short, the Kyoto Protocol went through that period all the way to 2012. So in 2012, the markets involved in the Kyoto Protocol were kind of already really diminished. And that was a result of the global financial crisis. There is quite a lot to be talked about on that, but we don't need to go into those details. Now, in the gap between 2012 and 2015, there was a lot of movement on what to do next. Okay, we went through a global financial crisis. Economy is already recovering. Emissions are back up again. What to do now? So there was a ramp up in that period towards 2015 when the Paris Agreement was finally signed. And again, that was an agreement that was not yet implementation. Okay, and the one thing that came differently with the Paris Agreement is now everybody has targets, not only developed big countries, emitters. Even the so-called considered developing countries will also have to contribute with emissions targets. That's one big difference there. Not adopt at all, like for example, the US and so on. So another thing that came out very prominently in the Paris Agreement, in the background discussions, and it came actually effectively as a boost to the voluntary carbon market subsequent to that, was the emergence of the Sustainable Development Goals. So the world, the society had changed as a whole, and now it's not only climate. There is a very big emphasis on sustainable development goals, on social contributions, biodiversity contributions, and so on and so forth. So the problem is actually bigger. It's much beyond climate. It's now how we tackle climate while at the same time continue to develop, while at the same time contribute to many other aspects involving society, right, including social development. So to give a dimension of where we are with the problem, right? According to the Paris Agreement, we are supposed to reduce over 50% net emissions by 2030, as compared to 2018 emissions. Okay, that's an absolutely massive reduction, a massive target. To be clear, so we don't see many numbers here, but the 50%, price tag there, should be enough to give you a perspective of how in 12 years we are going to be reducing emissions, right, to that level, something that has been ramping up for over a century already. So, and that's the big challenge we have in our hands right now. And there are many ways to tackle that challenge. And the voluntary carbon market, it's one of the tools that's going to be used, or it's being used already, among many other tools, in order to tackle this challenge. Right? I want to be very clear on this because there is a lot of controversy, right, about carbon market and everything. But the carbon market is really one of the mechanisms of many that need to be in place to be able to achieve that. And the carbon market is a transition to a net zero world. Just to give an overview of where we are and how the voluntary carbon market can contribute to that big target of 50%, right? We just discussed that. So around 2018, we are talking about, let's say, roughly 40 gigatons. There on the top of the screen, you can see, of emissions globally. Now, to reduce that by 50% by 2030, we're talking about a reduction of close to 20 gigatons. Okay? If we are to, let's say, if the voluntary carbon market as one of the mechanisms to achieve that reduction takes care roughly of 20% of that reduction, we're talking about a 4 gigaton type of mechanism market. So basically, 4 billion carbon credits a year being issued in that market. That's by 2030. Now, looking at 2021, for example, we had 353 million carbon credits issued in this market only. So we're talking about a ramp up here of 10 times in a market, right, in less than 10 years. This is probably unprecedented. Anyone who has been going through or has experience working in financial markets, this is something absolutely unprecedented in any financial market. So again, a massive challenge here, right, to be able to grow a market like that, but it just shows the prospect. It just shows why you see so many companies, so many businesses popping out in the sector, why we see so many people wanting to be in that sector, not only because we are really trying to do something by our planet and by the people in it, but also the economic prospects of being in this market. It's absolutely amazing. So with that, I wanted to give a quick overview for those who are not familiar yet, very brief overview on how a carbon market works. So it's a very simple concept. It's an offset market. It's basically, on the left side, you see a CO2 avoidance or removal activity. That's a carbon project developed by someone who does not necessarily has targets for emission reductions. It's doing that, for example, as a business. And that project itself, once it achieves its carbon reduction, there are many types of activities that can do that. To protect a forest that is under threat, for example, you are generating carbon credits because you are avoiding emissions annually with the deforestation, for example. Another way, very, very familiar to most of you, is renewable energy. So if you choose to generate power with the solar thermal or even solar panels, instead of burning coal, which is a big emitting technology. So the difference between the carbon that's generated through that process becomes carbon credits. So now, with the carbon credits in hand, a project developer or a project owner can go into the market and sell to the CO2 emitters. These are manufacturing companies, airlines, you name it. So anyone and everyone who emits, we have the ability to buy these carbon credits. And of course, once you buy, you have to make a payment. It's basically a trading, right? A trade. You're basically trading, buying carbon credits and making a payment. Now, the question is why the emitter would buy that. And in the case of the voluntary carbon market, because it's so-called voluntary, why would you do that in the first place? Why would you spend, good dollars for something that's, you have a choice not to do it? The key to understand here is that I usually say that voluntary ahead of the carbon market is kind of a misnomer, because since Paris 2015, what has been emerging very, very prominently is that corporates are buying carbon credits and are doing a number of other projects on social initiatives and so on and so forth, because they are being effectively directed by their shareholders and by their stakeholders. It's not like it's as much voluntary so far as your shareholder telling, if you don't do it, I remove you as CEO and I put another one. So it becomes something really, in practice, not as voluntary. And it's very, very powerful because it's bottom up. It's not like you're having a piece of regulation top down from governments, from politicians for you to do something. It's actually the ones who own your corporate dictating that you have to do that, and you will certainly do that. That's what's been happening, and that's what also points toward how much the carbon market has been growing, because you see a number of different corporates going forward declaring net zero targets. And they all in that process, right, of doing, of course, many other things within their own operations and their own facilities, not only offsetting, but also offsetting, right? One example are airlines. So an airline has no choice today other than offsetting if they declare they want to be net zero, because there is no technology to replace jet fuel, right, yet, right? Or no technology to replace an airplane that burns fuel overall. Right? So we see what's going to happen going forward in the future. But that's an extreme example where offsetting is probably the only option there. Where in a manufacturing facility, you still have a lot of options. You can switch your internal power generator from coal to renewables, or even to natural gas. If you just do that, you have a massive reduction on emissions and so on and so forth. Okay? In addition to doing offsetting as well. So now I want to give an overview under the voluntary carbon market of how a project cycle works. It's a very complex type of a mechanism. Okay, for you to be able to generate that carbon credit that you see, very simple thing on the screen here, takes a lot of effort and it takes big cost. It starts with the project design. Then you have to get financing. Then you have to go through a standard like Vera, gold standard, and so on and so forth, to get your project validated. You have to put together the documentation, the design. Hopefully, you have your financing in place at that point. Then you have to engage a consultant to validate your project. Only with that validation completed and all the paperwork in place, you can submit that for registration by the registry, by the standard, like VCM Gold standard. And there's a process of registration there. Once your project is registered, that's the only moment the project effectively is eligible to actually receive carbon credits. But you don't receive that immediately. You now have to operate your project from that point on. And let's say fast forward in a year from the point of registration, you have to monitor. There is a procedure for monitoring to provide evidence that what you said you were supposed to do, that you are going to do to reduce carbon emissions on that project, it's being done. And it doesn't stop there. So you have your evidence there, but an independent auditor has to come in and verify, which is the verification process. With those two pieces of evidence in place, now you submit to the registry, finally, for issuance of your carbon credit. So it can take anywhere for a year to, let's say, 4 years to get actually the first carbon credit from the moment you start your design process. So it's a lot of effort. And your issuance, as I was mentioning in the beginning of the presentation today, may come with a number of co-benefits, or let's just say contributions to SDGs, right? For example, a mangrove restoration typically can contribute to SDG 6, 14, 15. So you have cook stoves, for example, contributing to many developmental type of SDGs, especially social SDGs like zero hunger and so on. And the list goes on and on, right? So the voluntary carbon, not only the process of getting a pure carbon project in place is already very complex. Now, that process involves contributions to these SDGs, which makes it even more complex. So if the VCM, voluntary carbon market, is a good tool, an effective tool, one of them for tackling the climate challenge ahead, what are the obstacles to scaling it? Remember, we potentially can grow this from roughly 400 million a year to 4 billion by 2030, but that's a massive scaling. And what are the obstacles? You just saw how complicated it is even to get a project through, right? And the first block you see on the screen there, it's really about the certification, monitoring, reporting, and verification process. So there are a number of initiatives ongoing today, right, to actually reduce the complexity of the certification process, and also to reduce the complexity and the time frames for the MRV process, monitoring, reporting, and verification. There is a lot of discussion on digital MRV, how can we digitalize this process and everything. It's really a balancing act here, because you don't want to get a project overissued with credits that it does not really deserve, right? Because the process got a bit more reduced, or a bit more easier to go through. You want to keep the process thorough, but at the same time gain efficiency on how you achieve that. It's a big challenge, right? But there are a number of startups today already working on this challenge. And then on the second block, that is the offsetting credibility and acceptance. One of the things that happen a lot is that, people talking about questionable baselines. And the baseline here is like, okay, your project is generating 100,000 tons of reduction a year. Is it really 100,000? Or somehow in the documentation certification process, you actually inflated that number, right? So there is a lot of that, right? And it's something that, it's very much monitored and watched in the whole process of certification. And obviously buyers want to know, want to have a lot of clarity on that. And there is greenwashing, of course, right? It's like overclaiming, corporates overclaiming what they actually have done in terms of reducing emissions, buying very cheap and low quality offsets, and basically boosting that, through the marketing. And there is still very limited financing in the sector. And there are many reasons for that. In fact, part of that has to do with the third block that I'm showing on the screen, which is what we are going to be covering now, which has to do with value discovery and transparency. So the carbon market today is still what we call an over-the-counter market, it's an OTC market. There is indeed a lack of transparent pricing. So it's very hard to know at any point in time how much should I pay or how much should I sell a carbon credit for. Okay, that's typical of an OTC market, especially in its infancy, in its beginning, which is where we are today with the VCM. Another thing that creates further obstacle in terms of transparency is the complexity of the underlying offsets, of the offsets we are basically generating through projects and transacting. There's a lot of project information asymmetry of, for example, you actually don't really know certain aspects of the project that are quite important, like eligibility to instruments and everything. We're going to cover all of that. But all of that creates, a big obstacle there. And finally, you remember I was talking about the co-benefits and the SDG contributions. And, what's actually the value of these SDG contributions? They have been broadly overlooked in a lot of instances in the market, but there is a clear perception that they are valuable and that they do contribute to value enhancement in projects, but by how much exactly? So transparency is supposed to put that, bring that to the fore and create much more confidence for market participants to move forward, invest in projects, and of course, transact in these carbon credits. Okay, so with that, let's have a more thorough discussion here on the market transparency journey. And a case in point I wanted to highlight here, and it's not unique to this market, but it's a very good use case here, is the credit market. And when I say credit market, it started mostly with bonds, like debt securities, right? Bonds, which have been transacted like through human history. In the moment, the economy became monetary, right? With currency and everything, there were loans and bonds and so on and so forth. But the bond market really became hyperactive, or started becoming hyperactive, right in the beginning of the 80s and all the way to the 2000s, when it really scaled up big time. And I'm showing here on the screen the corporate bond. Like this is like debt bonds from corporates, not from governments. This market, of bonds, of government bonds, is way, way bigger compared to corporate bonds. But the corporate bond market is a very good basis of comparison with the carbon market, because as you can see on the screen, from the 80s all the way to the 2000s, what really started enabling the scaling of the market was the increase and enhancement of transparency. So at first, you started having pricing data more transparently offered and published in the market. Services like Bloomberg, like IC, who actually aggregate data and publish data on pricing of bonds, became much more prominent. And with the services being spread around financial institutions, it became much clearer for traders and of course for the corporates themselves issuing those bond securities. So what are the price points for the securities, and therefore more confidence in trading and transacting. So of course, the underlying security of a bond requires that you know much more detail about who is issuing those bonds. So that's corporate data. In those 2 decades, there was an explosion of services on data offering financials of companies, more clarity and aggregation of financials, which can be a very complex thing to do, and a ton of research, right, on the corporates themselves, right, like projections, forecasts, prospects for sales, for growth, and go on and on. So that type of corporate data, which has to do with the underlying issuer of the security, which is bond, became something very prominent, enabling that market in that period. And finally, the credit rating came along much stronger. Credit rating has been around since early 1900s, and S&P, I think, was there already in the 1800s. But there was again in those 2 decades an explosion of new corporate bonds and obviously new issuers, new corporates being rated by the 3 main rating agencies, S&P, Moody's, and Fitch. So you put these 3 things together, you can see here how this overlaps with the chart. Really a massive ramp up in those 2 initial decades, but a much bigger ramp up going forward now that that infrastructure is in place. So we're talking about like for less than $1 trillion in early 80s of issuances of corporate bonds to close to $8 trillion today. Okay, so the point I'm trying to make here is that the transparency that these 3 items here on the screen create is an enabling process that creates confidence and allows market participants now to more confidently deploy capital in a market. And I would argue that the carbon market will follow the same sort of trajectory, and it's already following. We are at the inflection point right now for that. So transparency feeds back into more market confidence, which in turn, more confidence translates in market participants being more willing to deploy capital into climate solutions, into carbon projects, into trading, into a number of different solutions that can provide this tackling of the climate challenge. Now, you see the date or the years at the bottom there and the exponential profile, which is pretty much how it happened. You saw on the previous chart, and we are seeing this profile already, playing out. If you see how the market was in mid-2021 and how it is today, it's already a massive growth in just a year. And the trajectory is expected to just continue in that direction. With that, we're talking about pricing data. We're talking about now project data. Remember the comparison with the credit market is the corporate data, the issuer. The carbon project is the issuer of the carbon credit. So project data, it's another big thing here, and rating. So let's walk you through this. So we're talking about pricing data in an OTC market. That is today really little transparency on how that works. You see a lot of price variability because one player doesn't know where the value is. You throw a price very high, another one throw a price that's very low. And in that respect, you end up with a huge variability and lack of transparency there. So what we at Viridios are providing today already as a solution toward what we're just discussing, transparency, it's a consolidating pricing curve of the market. So you are basically talking about a proper, complete pricing curve by vintage of each carbon project. So you see on the left side here, from vintage 2015 to 2025, we have the prices of each vintage consolidated from a process of aggregation of prices in the market. So on the right side, a similar thing, 2017 to 2022 for project GS 7312, gold standard. Again, a vintage curve, provided in the market by consolidating data from the market. This is what we're talking about in terms of pricing transparency. Is effectively and provide that confidence to traders and market participants of where the price points are for the assets they are effectively trading, which are the carbon credits by each specific vintage. And then we have project data. And we talked about SDGs, right? And the question is, what are the SDGs in each project, right? What are the SDGs projects are contributing to? Are there other impact measures in that project other than SDGs? And how do SDGs translate into value for a carbon project? So another thing, that has emerged over the past 1 year or so is the advent of standardized instruments from platforms like CBL Markets and Air Carbon Exchange. So what are the eligibility profiles of projects to those instruments? Those are liquidity enablers, right? And obviously market participants want to have confidence of whether that can be deployed into those instruments. And also, it can be things as simple as, how many credits have been actually issued and retired on certain projects. So there's very it's very hard. If you go into the registry, you have to put the number together for each project yourself. You're going to spend a lot of time putting that together, doing the calculations and so on and so forth. And what about project taxonomy? What are the actual activities that the project is employing in order to generate the carbon credits? So the solution, for example, on the SDG side that we have come up with, we have an impact tab on our platform. One thing that we do is, using natural language processing, AI technology, to scan through thousands of pages of documentation of projects to extract evidence for contribution to SDGs. We do that and we consolidate on our platform on the screen, as you can see here, giving investors and participants confidence, right? So all of this project has some contribution to these SDGs and so on and so forth. And of course, there are other impact measures like climate, community, and biodiversity, CCB. So we show on the screen projects that have that type of certification, and projects that have actually the accolades on that certification. Like, for example, we have biodiversity gold on CCB version 3 and so on and so forth. Other things that we do show that enhances that project data transparency is eligibility, right? What are what instruments the project is eligible to? So you can see that on the top left of the screen. The issuances, the consolidated issuance and retirements. So, how many credits and how many retirements have happened for certain projects by vintage. So all consolidated and nicely put for participants to have that in their decision making. And finally, the taxonomy, a number of different types of information on the project. So on the right side, you see two examples here of projects. For example, the first one is a household device project that actually does organic waste methane, basically distribution of biodigesters, which in turn is used to either provide heating or electricity for households. So you see there are three effective activities in that single project that provide carbon credits, right? This is not a sectorial thing that we're doing. We dig into the activity itself and showing what are the activities involved in generating those carbon credits. So another example at the bottom is a project that's a forestry project that not only does ecosystem conservation, which is basically protection and conservation of forests, but because it's in a coastal area, it protects mangroves as well. It's also a blue carbon project at the same time as it is, for example, a red project. Okay, so that type of transparency and clarity is very, very important for market participants in general. And finally, in that trio that I was talking about, there is project rating. So Viridios has partnered with V0 recently to display on the platform the ratings that V0 has been producing on projects, on specific carbon projects. So this is going to be launched, I believe, next week. Next week, we're scheduling to launch this on the platform. There will be a tab where you, for certain projects in the coverage by V0, will be shown its headline rating on the screen. So this another very important step towards transparency in the market is obviously to understand in depth the quality of the carbon credits of carbon that's being mitigated by certain projects. And that's what V0, companies like V0 are performing through their rating process. And one final activity that we launched recently to not only enhance transparency, but also to provide more liquidity to market participants is our request for code, which is already live today. We launched recently. So our subscribers now can go on the platform and actually submit requests for transacting to our brokers who are partners in that endeavor. So we see 4 brokers here on the screen today that have signed a partnership agreement with us. There are a number of other brokers in the process now of signing that agreement. That list is going to increase. And now not only these brokers have more access to parts of the market, like who are basically our subscribers, but it creates really an easy way for our subscribers to actually go and transact on the credits they already hold or to buy credits they want to hold. Okay, again, one further step toward liquidity and transparency in this market. So with that, I wanted just to show a very, very brief demo of the platform, and then we can jump straight into our Q&A. So we have today primarily three modules: projects, valuation, marks. And marks is that module that provides the prices that I mentioned. So this is a search facility, which, you get like all the projects that we're covering in prices today, 182 projects and growing today, with the full vintage curves on the screen. Okay, so for example, let's put that 1748 project example on the screen here. You see that full vintage curve we discussed. And then once you go in here, you can see a bunch of further details on the price, on the project itself. So you see the price on the screen there. So you see some historical profile here of how the prices have evolved for that vintage 2020. You see here the issuances consolidated by vintage. There is an impact tab that shows basically the SDGs this project contribute to, the CCB profile at the bottom of the screen here, and the eligibility to instruments, which is on the top of the screen, in the top right of the screen. So that's our marks marks module that we have today, and these are being used today by a number of participants in the market, not only for transaction, but also to mark their books. That's why we call marks. So it's a very financial term. That's how you put a daily prices or month-end prices in order to appreciate, how much gain or loss you've had in your portfolio. Okay, so the other project we recently launched is projects, which does not show the prices as we saw there, but shows a very broad consolidation of the projects that we have in the market. We are covering at the moment 6,907 projects. And each of these projects are in the process of being curated for us to identify, for example, SDGs and so on and so forth. A lot of the project data is coming directly from registries. So there will be a lot of raw data, like which registry, which country. We are doing a process of a tagging taxonomy, which is the type of the project, so how the project generates carbon credits here. But as we progress with this module, we are going to be adding like the SDG contributions, the eligibilities, and so on and so forth, which requires curation. We have a team of experts that curates projects one by one to provide very reliable and accurate data for market participants. And of course, one very cool feature here is the search feature, right? Or the filtering feature, where you can basically, like, you want to see only blue carbon projects. There you go. I have 37 blue carbon projects in the database today, even like with some of them curated already with eligibilities and so on and so forth. So you click inside, you see a similar screen to what you saw in marks with the CCB in this case, with sustainable development goals, and issuance is not yet there, but it's coming up. Eligibility is on the top. This project's under validation, by the way, so it actually just validated, just registered. It has not, is in that stage which has not generated carbon credits yet. That's why you don't see issuances here yet. Okay, and finally, this is where our company started, which is an artificial intelligence engine that can simulate any type of project, carbon project in the market, even those for non-existent projects. These are actually projects that are, for example, very useful for project developers who are interested in developing a new project that doesn't exist at all in a different country, so on. They can simulate the pricing for the project. So let me just give an example for over here. So Cambodia, ecosystem conservation is basically RED plus or RED, that's conservation of forests. So the standard is VCS, and we cover like 6 of the big standards in the market here. And then finally, the SDGs, right? You can mark here for a typical project like that. There will be quite a lot of SDGs. You can mark a few of them for the illustration. So you hit calculate, you get a price on the screen which has a range, bid and ask, basically a range of how much this project would be in fair terms worth in the market. So this is why our platform is today. There are a ton of new features, and there are new modules to come. Right? So we're going to talk about where we are and how this is going to move forward. I just wanted to highlight one more thing. So our platform is being used today to generate carbon indices, right? AI-generated carbon indices in partnership with S&P Global Platts. If you go to plattslive.com, if I'm not mistaken, yeah, plattslive.com, you'll be able to access these prices on a daily basis. So these are indices at the project type level. For example, household devices, or soil, like which involves regenerative farming. Eco-Protect, which is Red Plus, like forest protection. Eco-Create, which involves afforestation, reforestation projects. And each of the specifications of these indices will involve a different number of SDG contributions. And more recently, we also launched a blue carbon index. So we have a total of 7 indices being published. So that's a very, very major advancement for the market. So it just shows, how the market's maturing. The advent of new indices, new future curves, and so on and so forth is an indication of that process, that exponential growth process I highlighted before, of where we are right now, which is that inflection point in the market. And I'm going to close now with our vision for where we want with this whole story of transparency and so on and so forth. Our vision is to become the Bloomberg of the climate sustainability markets. So we have our VAI, voluntary market platform today, with those 3 modules I just demonstrated. But there are a number of different modules coming up. So very soon we're going to launch a markets module, basically a consolidation of all prices and instruments in the market. So in one screen, you'll be able basically to see where the market is, with futures curves, spot prices for different instruments, and so on and so forth. Another, very in-demand module is what we call knowledge, which is like news feeds, distribution of research from third parties. There's a lot of research going on. So we are trying to consolidate that on a single view so that participants can just go there, subscribe, and download to different pieces of research, and a number of other content that's very useful in the process of decision-making, in any market for that matter. And a number of other modules just for the voluntary carbon markets. In our pipeline, we also intend to develop compliance markets modules in a compliance markets platform, where now traders like on the UETS, on the California market, and so on and so forth, will be able to access like sentiment scores for the trading, for the price of the assets, trading analytics, a lot of risk analytics, like within the module we call Risk Engine, and so on and so forth. So with that, I do encourage everyone on the call to go and try our platform. So the URL is very simple. It's on the screen now, Viridios AI / try VAI. So just go there, and we have a 14-day trial, and you can appreciate for yourself what's being done and the type of transparency we are providing to the market.